Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day to 8 a.m. In this video, I am going to walk you through the process of valuing GW Pharmaceuticals stock by analyzing their financial statements and dissecting their financial ratios to determine if it's a buy or a sell. GW Pharmaceuticals is a British company known for its multiple sclerosis drug, Sativex, which was the first natural cannabis plant derivative to gain market approval in any country. Another cannabis-based product, Epidiolex, was approved for treatment of epilepsy by the US Food and Drug Administration in 2018. Let's get started with the model. This is a mid-cap company, market cap $3.8 billion. They're trading at $127 a share, and they have 31 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And this company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses, and they also have negative net income every year. But their revenue looks amazing. It goes from 11 million all the way up to 442 million. That's a growth of 40 times, 4,000%. This is the company's income statement. The top line is the revenue, the sales, and the trailing 12-month revenue is 442 million. Cost of revenue is pretty low at only 35 million, so they have a high gross profit of 407 million. But their operating expenses are high because they're a pharmaceutical company. Their research and development costs are really high, plus payroll. So their operating income was negative every single year. So they do have negative net income each year. Their lowest net income was in 2019 at negative 9 million. The only reason that is because they had a $100 million gain on the sale of property, plant, and equipment. But that gain will be reversed down on the statement of cash flows. So you can see the company's revenue was really small from 2015 to 2018, but really jumped in 2019, and it's going to keep growing more and more. Also, each year they've been adding lots of employees. They more than doubled the number of employees from 2015 to 2019. Because for a pharmaceutical company, when they want to develop a drug, it takes a lot of employee man hours, lots of research and development, lots of money. It could take many, many years to get approval from the FDA, because a pharmaceutical company has to go through a lot of trials and tests to finally get approval. So the upfront costs are exorbitant, but when a drug finally gets approved, that's when the money starts rolling in. In certain businesses, the upfront costs are minimal. For a tech company, it might be a few computers just for them to do their job, and then they could get some revenue. For a company like this, it could take hundreds of millions of dollars upfront without any revenue coming in. This is the statement of cash flows, and to calculate free cash flow, it's operating cash flow, which is on top, minus capital expenditures. So the company has negative free cash flow each year. The business is operating at a loss every year because they haven't made much money on drug sales, but it seems like the sales are starting to come in, and if the company does a good job at marketing the drug, the sky's the limit. The company doesn't use much debt to fund their business. They've been funding their business with equity. They issued $298 million of capital stock in 2018. Let's look at a capital structure. $33 million of debt, $726 million of equity. They pay 3.25% interest on their debt, and only 4% of that capital structure is debt, which means 96% is equity. Cost of equity is 17.4%. And to calculate cost of equity, we use the capital asset pricing model. And part of the CAPM formula is the beta. The beta is how volatile the stock is relative to the market. And their beta is about 2, so this stock moves more than 2 times the market. So it's pretty volatile. And their WACC, which is a blend of the cost of equity and cost of debt, is 16.75%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows. Past year 4, that's 15.1 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $9.1 billion. We divide that by 31 million shares. And we got a calculated stock price of $292. They're trading at $128, so they're trading at a 56% discount. It's a buy according to the model. Simply Wall Street's at $411 a share, so they're saying the stock is even more undervalued than me, so they're saying it's more of a buy. So even though the company has negative free cash flow, the expectation is they're going to have positive free cash flow now that their drugs are getting more traction in the US and European markets. So it looks like the stock peaked about 160 or 170 a year ago, and it's come down since then. It is trading at a discount relative to its all-time high. If you invested $10,000 into the stock when it IPO'd on the New York Stock Exchange, you'd have $142,000 today. That's a really good return on investment. These are the drugs in the company's pipeline, and their two main drugs are Epidiolex and Nabiximols. Epidiolex is for childhood epilepsy and Rett syndrome. Rett is a rare genetic mutation affecting brain development in girls. They also have some other drugs they're working on, one for schizophrenia, another one for autism, Rett, and epilepsy, and a third one down here. So there are two main drugs. The first one's Sativex, also called Nabiximols. This is a cannabis extract, and it's administered as a mouth spray. It was approved in the UK in 2010 for multiple sclerosis. In 2011, GW partnered with Bayer for distribution of Sativex in the UK, not the United States, and it's produced 100 tons of medicinal cannabis since 2012. Its other big drug, Epidiolex, was given US FDA approval in 2018, and was also given European approval in 2019. The company also lists the salary of its executives. Just keep in mind, 1 pound equals 1.33 US dollars. So the two main guys get about 400 to 500,000 pounds a year. And one of the executives gets 400,000 pounds of options if the stock hits a certain price. And both executives get about 5 or 6 million pounds of options based off of how the stock price moves. These options are only worth anything if a stock hits a certain price, and they vest over a number of years. Let's look at the financial ratios. The average PE is 14, the median is 14.6. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. The average price of sales is 6, the median is 2.2. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 9.0, so they're doing a bit worse than the median and average. Average price to book is 4.7, the median is 2.4. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 5.5, so they're pretty close to the average. Equity is assets minus liabilities on the balance sheet. The average interest coverage ratio is 12, the median is 3.8. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. EBIT is earnings before interest and taxes. The average ROE is 11%, the median is 11%. ROE is net income over equity. They have negative net income, so they have negative ROE. The average current ratio is 1.9, the median is 1.3. Current ratio is current assets over current liabilities, so they have way more than enough current assets to cover their current liabilities. A majority of their current assets are cash, $537 million. Since they have negative $106 million of free cash flow last year, they can last many years just with the cash on its balance sheet. You generally don't want a company with more than 2 current ratio, but for a pharmaceutical company, they need lots of cash on hand to go through the drug approval process. The best way to look at ratios to compare them to similar companies, I've done videos on AbbVie, Amgen, AstraZeneca, Biogen, Gilead, Horizon Therapeutics, Johnson & Johnson, Eli Lilly, Merck, Novartis, Pfizer, all in the same industry as GW. And if GW has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they're negative. Price to sales, they're a bit worse than the average. They are doing better than average in price to book. They have the highest current ratio of all the companies. Negative ROE. They're really low in debt. They're the lowest of all the companies. And they have the smallest market cap of all the companies, and they don't pay a dividend. So to summarize, I have them trading at a 56% discount because it seems like the cash is starting to come in from these drugs, and I think it'll get greater and greater as time goes on. But their ratios look pretty weak, and their financials also look kind of weak. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.